It's a big issue in the context of a market that's already been looking for reasons to go higher. I really do think that that's what we have to keep in mind, because yesterday you did get that pop on the headlines about Mnuchin's proposal about lifting tariffs. You didn't give it all back when you got the denial. Today, the Dow was up 150 points in the pre-market before you got the trade headline, and it acted as an accelerant. So I think it's just one other thing. The market's reaction to it has basically penalized risk aversion. That's been the story of the first 3 weeks of this year. Yes, you got the snapback rally, and everybody came into this week saying, well, the S&P is at a level where it really should stop or pull back. It didn't. Maybe we're going to sell the banks on the news when we get earnings. It didn't. Maybe a Netflix mixed quarter is going to have that one come back. And every chance people who were cautious thought they were going to get to buy it in a pullback hasn't happened. So I think today was a little bit of a capitulation of people saying, fine, it's not going to pull back just yet, especially if we have progress.
It's a total attitude change on the part of the market. I mean, look at Brexit and this pound rallying. That's far from certain.
Absolutely.
Look at the market rallying on a potential U.S.-China trade deal. Also far from certain.
Look at the credit markets. Look at oil up 3% today. So it's just kind of a risk-on feel because people were made to feel as they came into the year things were just too defensive in that overshoot to the downside we got in December.
Lindsey, are the earnings backing up at least some of the enthusiasm and the optimism we're seeing in this market?
Sure. Fourth quarter earnings certainly are. We're at 12.4% for the fourth quarter. We bottomed at 12.1%. It's really early days. We've only got less than 10% of the S&P 500 reporting so far. Obviously, the banks were the positive story there. The numbers were just decent, though. And I think it was really the story of the consumer was really strong. And these are stocks that were really beaten up, trading at under 10 times as a group, which is a very steep discount. So you're seeing stocks that have traded at a deep discount really pop on decent earnings, even if they guide down. And that's the thing. The guidance for 2019 is coming down sharply.
Lindsey, what do you make of within the bank's earnings of what they said about credit quality? Because you've been keeping an eye on corporate debt levels and whether that's something that we should be more concerned about.
Yes, it was definitely positive. Credit quality is still good from their perspective. But what I've been looking at is the bifurcation between what you're seeing in the large cap stocks versus the small cap stocks. The small caps, they're seeing a lot more debt. They're much more leveraged now than they were in 2009, which is the opposite for the large caps. Leverage right now for the S&P 600, 3.9 times versus 1.6 times for the S&P 500. Granted, the small caps as a total dollar value only represent about 3.5%.
Is this going to be the year where they get punished for higher leverage?
Well, it's all going to depend on what happens with growth overall. If we see a significant slowdown in growth, cash flow is going to slow. If we see interest rates continue to go up, or if the Fed doesn't stand pat, that's all going to combine to make it a more difficult year for them potentially.
Rick, what are you looking at today? I mean, we got some a little pullback in the consumer confidence, but I guess it's still at elevated levels long term.
Yeah, no, that was actually a fairly large pullback, but it is a preliminary number on Michigan. To me, the big story is we could talk, and I loved Kayla being here, because if you really think when Kayla left in September, there was a couple of things that changed. The Fed and volatility. You know, if you really think about how much you really know about what's going on in China, I mean, really know in terms of facts, numbers, we really don't know that much more. Add in the closure. I think Mike's hit it. Markets either can be pushed or they can't be pushed. They have a personality and a direction, and this market wants to do better in stocks. Interest rates for all 13 sessions of 2019 thus far, all yields, 2s, 3s, 5s, 7s, 10s, and 30s are at their highest levels of the year. And the balance sheet of the Federal Reserve has gone from $4.5 trillion to just under $3.9 trillion. Many believe the Fed's target was somewhere in the $3.5 trillion camp. I guess my point is, cut through all the clutter. The markets follow balance sheets up, they follow balance sheets down.